Welcome back, students who are taking financial accounting. In this series of videos, we are covering the theory for Chapter 8, long-term and other assets. Let me jump down to the slide. Okay, so in this video, we're going to cover reporting, and this is going to be very, very short also. Um, in this On this slide, um, you see the accounts and as I've listed them. Okay. Now, they're hard to read, um, but this here represents our balance sheet. So what I've done is on this next slide, I've actually just broken them in half. So that's easier to be able to see. So basically, this property, plant, and equipment came underneath machinery. So if you look up here, you can see where property, plant, equipment, and machinery is. So all I did was just take and moved these and put them over here, okay, on this next slide, so they're easier to be able to read, okay? Um, when it comes to reporting, you can look at the exhibit that's in the textbook, and to be honest with you, that's not how you see things reported on your balance sheet. Now remember, this here is a balance sheet, okay? And each balance sheet is individual to the individual company, depending upon what they have or they don't have. Okay, so this here is not a cookie cutter. I copy from this list of how I treat things. Okay, um, these are the general positions that things show up on your financial statements, and also realize that when I'm talking about this, I'm talking about smaller businesses. As the businesses begin to grow or get large, and when I say large, I mean you can think of, say, a Marriott hotel. All right, a Marriott hotel is a small business, even though it's a big building. Okay, um, you know, you, you can look around, and most of the businesses in a city are small businesses, even though they look large. But large businesses, they end up consolidating, they buy other companies, and their financial statements are, quote unquote, consolidated. That comes to mind PepsiCo. Okay, PepsiCo is the parent company of Pepsi Cola, Kentucky Fried Chicken, Pizza Hut, okay, and a few other entities. All right, so they all get consolidated under PepsiCo, and when you're looking at PepsiCo's financial statements, you realize, for lack of a better word, it looks sort of like a summary. Okay, um, that's why you see these great big thick annual reports, because there's just so many notes to what's there as far as the reporting is concerned. So when I'm talking about reporting here, I am kind of like talking about smaller businesses in the way it would be shown without a lot of the summarization, or it has more of the detail. And when it comes to reporting, like I said in the last video, we're talking about liquidity. And liquidity, everything is shown as far as liquidity, and liquidity means the ability to convert to cash. Okay, and that's the order that everything is listed. Right. So if our general ledger accounts are ordered in that liquidity. Now, of course, they break things up into current, um, and also long term. Okay, and this has to do with your ratio analysis, like your quick ratio, your current ratio, so on and so forth, that you've been studying and you're focused on decision making at the end of each chapter. So even though the general ledger accounts are listed in the order of liquidity, okay, we can add in descriptions like current assets and give us totals of our current assets. And the reason why we do that is, again, in order to be able to do analysis, giving us our ratios. But the more important thing is how are those general ledger accounts shown? cash is the most liquid, so it's the first one. Petty cash, as I explained in the previous video, I mean, it's just a matter of writing a check for your receipts. 1 hour, you actually have the cash back in the box. Okay. Marketable securities, you can push a button, sell your stock. That amount goes into your brokerage account. Then you can, push a button and have it transferred into your cash account. Half a day at the most. Accounts receivable is next liquid because it's you're extending someone credit for 30 days. If you need the money, you can call up and say, hey, I know I'm giving you 30 days as accounts receivable, but I need the cash now. Write me a check. And they have to write the check. Okay. People automatically assume if they have an accounts receivable that you've extended them credit, that they do get 30 days. Well, yeah, you're allowing them 30 days, but the reality is legally, you can call up and demand payment immediately. Inventory is next because, it's how quickly you can turn your inventory over, right? So those are like current assets. Then you get into your fixed assets, all right? Autos, computer equipment, furniture and fixtures, and machinery. Now, these can be sold off, all right, but it takes a little bit longer to sell them off, okay? Even if you're having a flash sale where you have a $50,000 car, brand new, you're selling it for $5,000, it's going to take you a few days to sell that car, okay? So we list our fixed assets next. And then we have what's called property, plant, and equipment, and that's the correct determination, the correct description, PP&E. All right, you'll see that, which it represents property, plant, and equipment. Right, property being land, plant being the buildings, and equipment being any equipment in the in the building. All right, these are obviously it takes a lot longer to be able to sell off the buildings and the land than it does to be able to sell off furniture or car or computer equipment. Right. So those are our long-term assets. Okay. After our long-term assets, then we start dealing with our other assets, which are intangible assets, and our natural resources. Okay. They give us a total other assets, and then of course, our current plus our long-term plus our other gives us our total assets. Now, I didn't put any of the numbers in. I didn't put any of the columns in, and in order to have a complete balance sheet, like I would have done here, okay, I could have put the numbers in the columns here in order to, represent what a balance sheet should look like. But, no two balance sheets are going to be exactly alike. I mean, let's face it. Remember, when it comes to reporting and we're talking about columns, our total assets over here, every time you have a mathematical calculation, so you can have everything in one column. And remember, that's called single step. And I know that this was covered much earlier in the first 3 chapters of the textbook, all right? But just as a refresher, you have a single step, which would be all the numbers in one column, I'm sorry. And it's very difficult to read, very difficult to understand what's on that financial statement. So instead we use multi-step. Okay, and basically what multi-step says is anytime we have a mathematical calculation, we move one column to the left, all right? And we put the total to the right, okay? So, and and we keep on doing that every time we have a mathematical calculation that needs to be done. So you can, depending upon the statement, you can be 3 or 4 or 5 columns wide, depending upon the, what it is that shows up on your financial statements. So if I'm going to look at total assets here, all right, which is what I want to know what my, since I'm only looking at the asset section, I have a long-term asset here, and I have my current assets here, all right? So these would be the 3, I take my current plus my long-term, which gives me my total assets. Well, obviously, my current assets have these accounts in them, all right? So they would be one column to the left. I'm doing a mathematical calculation in order to end up with my total current assets, okay? Now, and maybe I should have put in here long-term assets. Sorry about that. I didn't write that in. So my long-term assets would be these. And then, but now notice that when it comes to property, plant, and equipment, I would end up having an additional column here, which would give me my PP&E here. And then the total of these long-term assets plus my PP&E would give me my long-term assets over here, right? And of course, I would have my other assets here, right, which would give me other here, sorry. And that would give me my other here, so I'd have current, long-term plus other to give me my total assets, right? But as you can see, you know, it's not that easy to be fleshing this out, and that's why I didn't do this. And especially since that each and every business is an individual business, they're not all going to be exactly alike. But just realize that when it comes to reporting, you know, we're going from most liquid in general ledger accounts to least liquid. And then depending upon how everything needs to be analyzed, we go from current to long-term to other, right? And whenever we have a mathematical calculation, we move over one column and have the total go in the right-hand column. Okay, so that's how things get reported. You know, go ahead and watch the chapter, watch the Introduction to Accounting and Business videos, which kind of explains this a little bit more, and also chapters 1, 2, and 3. All right. By now you should be accustomed to it, and really this here is just kind of a repetitive thing. You know, just by virtue of the fact that you know, if you work with the stuff and you've done the homework, you should be accustomed to where these things are located on your balance sheet. Okay. So if you have any questions, go ahead and rewatch those videos. You know, rewatch this video, and if you still have any questions, you know, feel free to contact an instructor.